Good afternoon, and welcome to today's webinar, 5 Smart Investing Strategies. My name is Nathan Crampy. I am a certified financial planner and vice president here at Summit Investment Advisors. As we go through and really start to dive into today's webinar, I actually want to go through a couple different items with you with respect to how to use this new software that we're using and make sure that you can navigate everything correctly. So what I would like to do is actually bring in kind of the toolbar itself. And for those of you who are listening, you have a number of different avenues and aspects with respect to the use of this toolbar. First of all, you can be minimizing and expanding the software just by clicking on the toggle button there. That is something that if it does minimize, you can have access to it at any time again. Next aspect is that there will be areas that you can ask a question for chatting. Please feel free to go in and chat your question here. We will either get to it as we're going along, or at the end, once we are finished, we can answer questions there. So please go ahead and do that. Now, just to kind of get started here, let's just kind of figure this out a little bit. Go ahead and pull up your chat bar right now, and you can actually chat either what company you are working for, or if you are retired, what company you retired from. Go ahead and do that right now. And we'll just take a quick minute here just to make sure that everyone is able to figure out the chat bar and how that works. Also, if you do have any issues in hearing us or ways that you need some assistance, chat here as well, and that is definitely something that we can answer as the webinar is going. Okay, well, we're going to go on from here. So I would like to introduce our speaker for today, Sean McDermott. Sean is a certified financial planner with Summit Investment Advisors, and he's also the president here. He has over 26 years of experience, and he has been in Money Magazine with the Financial Planning Association, and is listed as the top independent wealth advisor by the Minneapolis-St. Paul Business Journal. Ladies and gentlemen, Sean McDermott.
Thank you. And thank you, Nate. Good afternoon, everyone, and welcome to 5 Smart Investing Strategies. While there are many sound investment approaches, we're going to review 5 that have the potential to benefit the greatest number of investors. So understanding these strategies can help with your portfolio's long-term results. So let's jump right into the 5 strategies. The first one is going to be don't try to time the market. You'll learn that missing just a few days in the market can dramatically reduce your investment results. The second area we're going to dive into is on reviewing your asset allocation. And asset allocation is dividing your investment between different asset allocation or different parts of the market. Third, we're going to talk about how to choose the appropriate investment for your situation. These days, there's a lot of different investments out in the market. There's stocks, bonds, there's real estate investment trusts, mutual funds, exchange-traded funds, there's annuity-type products. So which one is best for you? Fourth, we're going to talk about dollar cost averaging. Dollar cost averaging is a way of systematically investing into the market over longer periods of time. So a lot of people are already doing this with their 401k by investing monthly, or possibly employee stock purchase plans. Fifth, we're going to talk about rebalancing your portfolio and how important this is as your needs and goals change over time. I'd like to start off with an ancient parable that relates to investing. It's about some blind men who touch different parts of an elephant and they describe what they're feeling. One man, he runs his hands over the tusk of the elephant and he describes the elephant as a spear. The next man touches the belly of the elephant and he describes the elephant as a wall. Third blind man touches the tail of the elephant, and he describes the elephant as a rope. And then there's a fourth man, he touches the leg of the elephant, and he describes the elephant as being a big tree. Now the parable of the story is each one of them is trying to make judgment with limited information, so they miss the big picture. They are all right in the sense that they have formulated their opinion and as to what they're feeling at the time. So now, how does this relate to the current stock market environment and the investment situation that we're in? Well, what we're seeing is that a lot of people are making limited judgments with limited data points. So for example, a lot of investors out there in Wall Street, everybody from Main Street to Wall Street, is trying to figure out what's going on with interest rates. Is the Federal Reserve going to raise interest rates today? How will that impact the stock market? There was a slowdown in China's economy. Well, how is that going to impact stocks? Are stocks going to go up or down because of that? So again, what we want to do is focus on the bigger picture, the macroeconomic picture today, and try to help you make sound investment choices. Now this slide here illustrates a typical investment cycle for individual investors. So what you really want to do is buy low and sell high, but that's very difficult for a lot of investors to do. And what usually ends up happening is people buy high because there's a lot of enthusiasm in the market, and then when there's downturns in the market, they end up selling low. Now, one of the first things that we learn as investment advisors is we want to do just the opposite of this. We want to buy dips in the market. And I remember back in 1989 when I first started in business, that was over 25 years ago, the market went down and my phone rang at my office. My mother was calling me and I was going, I wonder if she's calling to say, hey Sean, stick with the business, things are going to be okay. But my mother was actually calling to buy stock. And she bought 100 shares of stock, and back in the time it was called Dayton Hudson Company, because she said she was watching the stock for a long time and was waiting for a dip in the market to buy in. So, if you could take that advice and buy in dips in the market, oftentimes the smart investors make a lot more money that way. Just one other example I'll give you on this fear, greed, market timing cycle. Right after Labor Day, one of the most wealthy investors, billionaire guru, Warren Buffett, was interviewed on CBNC's Squawk Box. And they asked Warren, they said, well, what do you think about the current interest rate environment? What do you think of China's stock market? And Warren, he said, well, we don't talk about that a lot at our office. What we focus in on is buying stocks that are going to be worth more 10 years from now than what they are today. So again, he focuses on the long term, and we think that's very important, especially in today's volatile market environment. Let's talk about market timing. And this chart is very important to look at because there's been a lot of swings in the market recently. There was recently a big point drop, 1,000-point drop in the market just on August 24th because China said, okay, our economy's slowing. And the market opened, and for investors that pushed the sell button on that Monday morning, investors in exchange-traded funds lost 30% of the value of their portfolio. And so oftentimes I'll have investors to say, well, why don't you just sell out of the market when it's going down? And a lot of times that's a lot easier said than done because you could take on a lot of risk if the market starts to climb later that day. So the market on that day actually finished only down 5%, not down 30%. Let's take a look at these charts. So I turned the video off. I want you to focus on the charts talking about missing the mark. And what we're looking at here is the Standard & Poor's 500 average annual returns from 1994 to 2013. You'll see that in that 20-year time period, the stock market averaged a 9.22% rate of return if you're fully invested in the market. Now, what's interesting about this study here is that in this period of time, a 20-year period of time, there's on average about 251 trading days in the year. So that amounts to 5,020 trading days. So if you're out of the market 5 of the 5,020 trading days, your rate of return wasn't 9.22%, it was only a 7% average rate of return. If you miss the best 10 trading days, your average return dropped to 5.5%, and if you're out of the market for only 20 days out of 5,020 trading days, your rate of return was reduced down to 2%. So what we're illustrating here is you got to be really careful about market timing, and there's a lot of gurus and experts out there that say they manage hedge funds that can get in and out of the market quickly enough. However, we've looked at studies and we've asked for past performance results, and there's not any firms that we've ever come up with that have said, okay, we can efficiently time the market. The risk is that you're going to miss the upside of the market and miss out on average rates of return of your portfolio. So again, be really careful about trying to time the market. Now this is a very interesting study to look at. Let's focus in on the slide. So this is called the law or flaw of averages. It shows the Standard & Poor's 500 index between 1926 and 2013. The stock market actually averaged a 10% rate of return. So average annual return of the S&P 500 is 10%. So a lot of investors think that they're going to earn 10% rate of return every year. And here we're talking an 87-year period with the stock market. So what is this 0 for? What the 0 represents is the number of calendar years the market return was between 9 and 10%. Isn't that crazy? Over an 87-year period, the stock market never averaged 9 or 10%. Instead, it was either higher or lower than that number. Let's look at the number 5. That's the number of calendar years the return was between 8 and 12%. So again, the results are pretty crazy when you see that the market very rarely is in the range of an 8 to 12% rate of return, and then the number 24 represents the number of years the market actually had a negative rate of return. So what this is showing us here is the market very rarely averages 10% growth. And oftentimes investors get impatient because their portfolio is not averaging 10%. Instead, what they have to do is you have to wait for good years, and sometimes you're going to have some marginal years, and on average you should earn about 10% over longer periods of time. There's a famous investor out there, his name is Peter Lynch. He's a longtime manager of the Fidelity Magellan Fund, and one of his quotes, he said, "There are no bad mutual funds, there are only bad investors." And I think there's a lot of truth in that statement. Next slide here, what we're talking about is asset allocation. And I'm going to focus in on the chart. What we're looking at is 91.5% of the performance of a portfolio is due to asset allocation, and only 8.5% of a portfolio's return is due to investment selection. So what is asset allocation? Well, asset allocation is the selection of your investments. So it could be the selection of stocks, bonds, real estate investment trusts, whether you're having international investments in your portfolio, small cap, mid cap, large cap. So a lot goes into asset allocation, and 90% of the rate of return of your portfolio is summed up in what investments you're actually diversifying into. And again, only 8.5% has to do with your selection. So what does this mean to you? Well, we find that a lot of investors these days are so focused on the fund selection, and they might be going, okay, well, we always want to have this investment because it's 5-star rated and has the lowest expense ratio, when actually they should be focusing more on how to diversify the portfolio. And I've always thought the cost of professional advice is a lot less than the cost of doing things wrong, especially when it comes to something as important as your kid's college, retiring on time, and you know, knowing and understanding and taking full advantage of the different tax laws. So if you don't know a lot about asset allocation, definitely I would recommend talking to a professional about it. Now, selecting among the different asset classes, again, 90% of the influence of your portfolio is due to how you select between these different asset classes. And, you know, we see mistakes being made in this area. I'll give you an example. I recently had a client that was referred into our firm that had a fairly sizable portfolio. It was right around $1 million in their nest egg. And in their portfolio, 50% of it was in a money market fund, 25% was in a stock fund, and 25% was in a bond fund. So I said, well, you know, the money market fund, they know and I know that that money market fund earns less than a 1% rate of return and that it's not growing at all. And so I said, well, why is it in the money market fund? And they said, well, you know, our in-laws told us that they got out of the market because there was some issues going on and the sky is falling basically. And so we took our money out at that time. I said, well, when was that? And they said, well, that was about 3 years ago. So if you think about it, this investor, they've been sitting at 1% for the last 3 years with half of their nest egg. And what that is opportunity cost. It's really difficult to make up for those lost years of return and interest in the portfolio. So again, you know, if you're not sure about asset allocation, look for a professional's advice in this area. I love this chart. I'm going to focus in on it here for a minute. So this is investing across multiple asset classes, and what we're looking at here would be the different areas that you could potentially allocate into on a year-by-year basis over just the last, I believe we're looking at over the last 10 years. And let's follow one of the asset classes. For example, commodity investing in 2005 was the best return. It earned 21%. And then the next year it became the worst returning investment. And then in 2007, one of the best, and eventually one of the worst to the best to the worst. And it's quite a roller coaster ride. And I refer to investing in one type of investment. It's kind of like going down to Valley Fair and riding that big green roller coaster called the Wild Thing. So we want to avoid big swings in our portfolio. Right in the middle here, you'll see a diversified portfolio. So the diversified portfolio will give you kind of the smoothest ride over time. So it's kind of like riding that roller coaster down that Valley Fair called the Mild Thing. And the Mild Thing is a much smoother ride. And so instead of chasing returns, what we recommend to investors is spread out the risk, because we don't know what's going to be the next best asset class, and you want to be diversified. The investment selection process is where you're researching the funds or the securities to own inside of your portfolio. And there's a lot of great resources these days out there that are easily accessible online. We like to use things like Morningstar and Lipper ratings to build portfolios. We recommend that clients do try to find the best performing funds in each different areas. So if you think about this analogy, it's kind of like building a team of baseball players. So think about the Minnesota Twins, first of all. The Minnesota Twins, they're a professional team. They're pretty good this year. Hopefully they make the playoffs. But on the Minnesota Twins, they only had one all-star player this year. And so if you took the Minnesota Twins and put them against an all-star team, the Minnesota Twins wouldn't stand a chance. to beat that all-star team. So this is something that relates to investment selection process where you're hand selecting the best performers in each category. For example, you want to find the best large cap growth fund, you want to find the best international fund, and we're recommending to our clients to make sure you're using hedged international funds. We want to try to find best bond performers and so on and so forth. So if you're loading up your portfolio and your asset allocation with some of the best performing funds out there, you're going to end up with an all-star team. Now, asset allocation also refers to, a little bit to that baseball analogy that I'm using. And that's where, as the game changes, you want to adjust the players on your team. So for example, if somebody's bunting, you're going to pull the infield in. If somebody's batting left-handed, you want to shift your players more towards right field. If the pitcher is not putting it over the plate, you're going to warm up somebody in the bullpen. Now, that can be a lot to keep track of as the economy changes. If international investing is stronger, well, maybe you want to put more money there. Or if interest rates are going up here in the United States, maybe you want to shorten the duration of your bond portfolio. So a lot goes into the game. And, if you think about the owner of the Minnesota Twins, the Pohlads, they don't go to 156 baseball games in a year. Instead, they have a team manager, Paul Molitor, that goes to all those games and keeps an eye on the players and helps select the players. So if you don't have time or the inclination to be doing this stuff on your own, again, try to find somebody to help you that's, a qualified professional that can help you allocate the team and with your investment selection process. Long-term look at performance, as you'll see in this next chart here, stocks over time historically have given the highest average, a better return than bonds, a better return than just having cash in your portfolio. But this can actually change on a year-by-year basis. So let's look at this scoreboard here. I'm going to focus on the slide for a minute. So which asset class had the best performance? So we have cash, bonds, and stocks. And then we go year by year. So you can see in 2005 and 2006, stocks had the best average growth rate. But then in 2007, bonds did better than stocks. And then in 2008, when the market had a downturn, cash was a better performer than bonds and stocks. So you can see year by year, the asset class that performs best is going to change. And what you want to do as investors is possibly adjust those asset classes or have diversification. So, if there is a correction in the market, that you're leaving those types of investments invested for the longer term. Let's talk about dollar cost averaging. Now, dollar cost averaging, I've included a couple slides here, and it's low. I'm not going to go through them, but you can print these or we can email these out to you. But basically what you're doing with dollar cost averaging is investing on a periodic basis. Typically, people will be investing into their 401k or stock purchase or IRAs on a monthly basis. Some people do dividend reinvest into their stocks. What we've found over and over again through time, and I do basically in a year's time, I'll do 100 financial plans. In 25 years, I've done over 3,000 financial plans. The investors who I find have the most amount of money in their portfolios and their nest eggs are the ones that have systematically dollar cost average and purchase securities over time. So they don't, start and stop and get in and get out. Instead, they continue to buy into the portfolio. That's what dollar cost averaging is all about, sticking to a plan and continuing to invest over time. Let's talk about balancing your portfolio. So balancing your portfolio, I'm going to take a look at the slide here. What we're illustrating is a conservative portfolio, and we show this diversified between 20% stocks, we have 20% in bonds, and 60% in cash. And this is over a 20-year time period. The average annual return has been 6.1%, with a worst year of 12% and a best year of 15%. So in this example, the average was 6%, which isn't too bad, However, 10 years ago, cash was probably a decent investment where you got, maybe a 5% rate of return on it or 5% interest rate, where these days cash is paying below 1%. So this portfolio probably wouldn't earn 6% going into the future. Now let's look at another portfolio. This one is our aggressive portfolio. It shows stocks at 80%, bonds at 10%, and cash at 10%. So initial investment $100,000 over 20 years grew to $580,000. Average rate of return, there you go, that 10% again. So worst year though, you got to see here is a negative 32%. So as an investor, you have to be able to accept that volatility in the portfolio in order to attain greater rates of return. So again, your portfolio allocation is going to depend on your risk tolerance. It's going to depend on when you need the money from your portfolio, how soon you're going to retire, and how much money you need. It could be depending on when your kids are going to college, and so on and so forth. So history has told us over and over again that the longer you're in equities, the greater the rate of return, and they do have a tendency to outpace stocks and bonds. Of course, past performance isn't any guarantee of future results. Over time, you want to rebalance your portfolio. Basically, as you approach your goals, your portfolio could end up having too much in maybe, in this example here, over 20 years, the investor started with 60% in bonds, 40% in stocks, but at the end of the 20 years, they ended up with 53% in stocks and 47% in bonds. The stocks basically outpaced the bonds. And so at that point in time, it would be a good time for them to rebalance and reallocate according to their goals. So where are you? And what does your money say about you? So there's many different investment classes we learned, and it's very important. 90% of the rate of return of your portfolio depends on your asset allocation. So the first step that we want to take for ourselves is tallying up how we're diversified. And oftentimes we're running into investors that have several accounts going on. They have 401ks, they have IRAs, Roth IRAs, plans from past employers, and it's difficult to figure out, what percent they have in stocks, bonds, and cash, what percent is international, what percent is domestic. And so the very first thing that we want to do is, as a starting point, is figure out what percent you have in each area. It's almost like using Google Maps. Everybody has probably used Google Maps recently, and they ask you for two data points. One, where are you? And the second one is, where do you want to go? And then from there, they map out the most efficient route. They can tell you where the traffic jams are at. They can tell you the mileage, how many minutes it takes to get there. So again, find a starting point, figure out where your money's at. That's part of your homework to do in the next few days here. Elements of sound investing. Everybody's at a different stage in their life. So no matter what stage you're at, whether you're buying your first home or accumulating for kids' retirement or kids' education, or possibly building up your own retirement portfolio, all five of these strategies I can think will really help you. As we said, first of all, don't try to time the market. Secondly, make sure you have proper asset allocation. Third, rebalance your portfolio. Fourth, dollar cost average into the market. Keep investing over time. And with those things in mind, I believe you should be able to have a better managed, less risky portfolio. And at this time, I'm going to turn the mic over, or the rest of the presentation over to Nate, and we should be able to answer some questions. Nate?
All right. Well, thank you, Sean, for kind of running through that. What I would like to say is that go ahead and start typing in the chat any questions that you have. And while you're doing that, I wanted to kind of run over a couple elements to what's to come. And with that, one of the things that I wanted to highlight is that we do have a recording of this that we will be making available to you. So you should be receiving an email either later on today or first thing tomorrow morning. Go ahead and you can definitely share that with your friends, colleagues. That is definitely something to have a replay of today's video. Now, also, what I want to highlight here is that we do have, and we should all be seeing my screen there, we do have now another workshop that's coming up. It's the Retirement Matters Investment Strategies for Retirement. That is another workshop that we will be doing here on October 15th. So please go to our website, summitinvest.com, to sign up for that, and you can definitely attend. Also, we did give our contact information here as well, so you know how to get a hold of us with any questions. Both Sean and my email are here. We would definitely ask that as you have questions, please give us a call, and as you want to schedule an appointment, please give us a call as well. We can definitely go ahead and do that. So as of right now, does anyone else have a question? I am not seeing right now any questions. We'll just take one more second to see if anyone has questions for kind of us about today's webinar.
Nate, I think one. Nate?
Yes, Sean.
Yeah. One question that keeps coming up on an ongoing basis is whether the Federal Reserve will be increasing interest rates today, and we'll find that out in a half hour. They certainly have been talking about it for the last 3 years, and it's a little bit over talked about at this point. And we kind of feel as a company that the markets have probably already adjusted to no matter what they're going to do, whether they raise them or don't raise them. So, we're not going to, again, we're keeping that long-term perspective. Our economists still feel the market should have some growth this year, and we'll continue to see some recovery. So that's all good news.
You're right, Sean, that we do feel that we do have some growth left in the stock market as well as the economy. Now, what you mentioned, there's a lot of things that we feel is kind of baked into today's, I guess, decision by the Federal Reserve, whether that is no decision or if they do decide to raise interest rates. I would like to add, though, that more than likely, in one way, shape, or form, there will be some emotion that comes into the stock market as well today. So if you've been following what we talked about today, the emotion just from the minute-by-minute little changes in the stock market should not have really an effect on the overall portfolio.
Last thing I'd like to mention is that the handouts and the slides. There's a couple supplementary handouts that are available. If you look on your toolbar from the webinar, you'll notice a section there that says handouts, and you can download those handouts or download the slides if you'd like. Or just shoot us an email. We can email those over to you. I think with that said, I think that's a wrap for today. We are going to redo this presentation here at our conference center at 4 p.m. this afternoon, so you're welcome to join us. Otherwise, we're planning on doing a webinar again the third Thursday of next month, and we have a whole series coming up throughout this year. And again, thank you for joining us, and we appreciate your time.
Thank you.